Traditionally, you had equities and you had fixed income. Okay, fixed income was where you lent money to governments as a loan and you got a return. Of course, the returns weren't as great as in equities traditionally, but the volatility was lower, so lower risk, lower reward. That's been questioned for a long time now, especially after the credit crunch where interest rates were driven lower. Therefore, the idea was there was less incentive to hold safer assets like gilts, take more risk, go out and spend more, lend more to companies and so on. Well, after COVID, the same thing's happening again. And once again, the criticism's coming in that actually should you have as much fixed income as traditionally your wealth manager or your independent financial advisor might have suggested. Of course, if you're older and approaching retirement, you do want lower risk, but the returns that you're getting are so much lower than they used to be historically. So which way do you go? What do you look at? It's one reason why equities have been shooting up so much more. So all I'm saying is be a bit more conservative when somebody says to you, oh, fixed income, you should have this, here's the traditional way of doing things. Well, actually, the cutting edge analysis out of the banks like JP Morgan suggests that may not be the right way to be doing things because equities are so much more levering ahead. And not only that, the fixed income side is generating so little return. If you truly want safety, cash, either in a bank account or under your mattress. But the low yield bonds or low yielding bonds are not giving the return. Now, of course, sophisticated investors get access to junk bonds and exchange traded funds of higher yielding bonds. They carry their own risks, of course. But just to say the traditional method of, oh, you just put it in fixed income, got some fixed income bonds, government gilts, US treasuries, it's not generating the returns that you might be thinking, and in effect, you're getting you're going to be missing your retirement targets as a result.